DSCR loan rates and conventional mortgage rates both jumped 26 basis points this week, with the 30-year fixed climbing from 6.09 all the way back to 6.35%. If you thought sub 6% was right around the corner, this week just slammed the door. The labor market refused to crack. A war overseas lit the fuse on yields, and rental property investors are now staring down financing costs they haven't seen in months. Stay until the end. I am going to show you exactly how keeping your liquidity reserve strong can lower your DSCR loan rate even in a market that just moved 26 basis points against you. The job market that won't quit. Why strong employment is costing you more at the closing table. On Thursday, March 12, the Labor Department reported initial jobless claims of just 213,000 for the week ending March 7, down another 1,000 from the prior week, with continuing claims dropping to 1.85 million. Those are not the numbers of an economy slowing down. A tight labor market signaling to the Federal Reserve that the economy can handle elevated rates, which reduces the urgency to cut. And when rates cut, expectations fade, treasury yields climb, and mortgage rates follow. For DSCR investors, there is a cruel irony here. A strong job markets keep your tenants employed and paying rent, but it also keeps your costs to borrow uncomfortably high. This is the rate environment you are operating in right now, and it didn't happen by accident. Oil, war, and your mortgage rate, the geopolitical wildcard nobody's pricing it. While the job data drove the first leg of this week's rate spike, geopolitical tension provided the accelerant. Ongoing conflict in the Middle East, particularly the Iran war narrative, pushed oil prices higher and injected an inflation risk premium into bond markets through March 7 through 11 window. When investors get nervous about inflation reigniting, we have reviewed that in prior videos, they demand higher yields on treasury bonds to compensate, and mortgage rates move in lockstep. This matters because it is a wild card that operates independently of Fed policy, jobs data, or anything else in the US economic calendar. For real estate investors evaluating whether lock or float, this is the variable that can move your rate sheet on a Tuesday morning with zero warning. Macro and geopolitical shocks can move your cost of capital even in weeks without a single major US data release, and these weeks proved it. Now let's look at the rate update together with the major economic indicators and how they are affecting your wallet. 30-year fixed mortgage rate started at 6.09%, ended at 6.35%. That is a 26 basis point move higher in a single week. One of the more aggressive weekly swings we have seen in 2026. Sadly. DSCR loan rates, which typically run about 0.75 above conventional mortgage rates, moved right along them. If you were looking at DSCR financing around 6.84% at the start of the week, you're now looking at rates closer to 7.1 depending on your file. Your move, lock now or keep gambling on a pullback? Here is the honest read on where we are. This week's 26 basis point surge wasn't random noise. It was driven by two converging forces that aren't going away quickly. A labor market printing 213,000 jobless claims week after week is not going to flip overnight. And geopolitical tension in the Middle East has no scheduled resolution date. That combination argues against floating and hoping for a quick reversal. If you are within 30 to 45 days of closing on rental property, the case for locking your DSCR loan rate right now is stronger than it was even a week ago. Rate volatility is the enemy of deal certainty. And when two independent forces are both pushing in the same direction, that is not a market to be clever with. For investors in early stages of acquisition, 60 to 90 days out, watch jobless claims data every Thursday and monitor oil prices as your two leading indicators for whether this move has more room to run. If claims stay below 220 and oil stays elevated, expect DSCR loan rates to remain in this uncomfortable range through late March. Now, let me unpack the strategy I promise you. Show strong liquidity reserves. In DSCR lending, lenders aren't just looking at the property cash flow, they are also evaluating how much runway you have if something goes wrong. Borrowers who can demonstrate 6 to 12 months of reserves in liquid, accessible accounts present a materially lower risk profile to lenders. That reduced risk gets priced into your rate. In a market where DSCR loan rates are already sitting near 7%, having strong reserves could be the difference between a 7 rate and a 6.5 rate on your next deal. An over 30-year hold on a rental property, that gap saves you thousands. If you want to explore other strategies that work better for your specific situation, call or text me directly. Our info is in the description below, and I will walk you through exactly how to position your next deal for the best possible pricing. And just like that, this is already obvious. Thanks for watching. If you found this video helpful, give it a like and subscribe for more expert insight on real estate investing. If you are ready to take the next step or have questions, call or text me at 718-300-3503. I'm here to help you understand the market, find smart loan options, and turn today's challenges into tomorrow's cash flow.
If you want to learn how to use financing to grow your portfolio, check out my DSCR Loan Tips and Tricks playlist. Inside, you'll find powerful strategies, lender insights, and real-world tips to help you close more deals and maximize your cash flow.